morning, and thank you for joining us for today's web seminar, 2021 Market Outlook, Where Do We Go From Here? I'm Karen Weitzkopf, Vice President of Marketing at First Long Island Investors. First and foremost, we hope everyone continues to be healthy and doing well. We have a great agenda planned for today. I'm joined this morning by some key members of our investment committee. Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, Philip Malakoff, Senior Vice President, Wealth Management and Director of Research, and Brian Gamble, Vice President of Wealth Management. Additionally, other members of the committee are available to answer any questions if we need it. Before I hand it over to Bob, I'm going to cover a few quick logistical items. First, all participants are currently in listen-only mode. Second, after the team delivers the presentation, we'll have time for some questions and answers. Please don't feel that you have to wait until the end of the session to submit your questions. You can submit them as we go, and we'll save them for the end. At this point, everyone should see a slide that says today's speakers. If you don't see it, please put something in the chat window, and we'll do our best to help troubleshoot. And finally, our General Counsel always asks that I remind you that today's session may discuss the performance of some strategies, and that past performance is not a guarantee of future results. In addition, given some of today's topics, it's important to note that anything discussed on this call should not be considered as medical advice. So with that, I will hand it over to Bob.
Thank you, Karen. Good morning. I hope you're all well, and please adhere to CDC guidelines. Our agenda this morning will be to cover an update on the COVID-19 pandemic, which is still very much with us, and economic and market overview, areas to watch as investors, the FLI investment approach in this market, a summary, and then a Q&A. We go to the next slide, please. As you know, we put out a thought piece earlier this year, as we do each year. And that thought piece had a quote from a very fine investor, Shelby Davis. It's invest for the long haul, don't get too greedy, and don't get too scared. And I chose that quote because we're coming out of two very strong years of performance. 2019, where we probably expected it because of increased earnings and low interest rates and low unemployment. And then 2020, when we probably wouldn't have expected it because we were hit with an exogenous event of the pandemic, which forced a shutdown of our economy, created a great level of anxiety, and unfortunately has impacted all too many Americans and people around the world. So after these two very strong years, please don't get too greedy. But on the other hand, if we do hit a correction, if we do hit even a bit of another recession at some point down the road, don't get too scared, because emotion will drive investors the wrong way. And that's where a prudent asset allocation comes in. As you know, at First Long Island, we have always spoken of our mission of investing for the long term and compounding your net worths. We do that by being long-term quality investors. So please heed this quote. Invest for the long haul, don't get too greedy, and don't get too scared. Next slide, please. Because we are still confronted with a 100-year pandemic of COVID, which started in China and then spread across the world. And as you can see from this slide, as of the 9th of February, globally, more than 100 million confirmed cases of COVID-19, and here in the US, over 27 million. And the most unfortunate statistic is in America, 465,000 people have passed away, and around the world, in excess of 2 million. The good news is that last year, towards the end of the year, 2 vaccines were approved by the FDA under an emergency use authorization. And really what the EUA means is that it has not yet been formally approved by the FDA, but given its efficacy and the need the reward outweighs the risks, and they've been given this emergency use authorization. So as of now, in the United States, 42 million people have been given at least the first dose of their vaccine. And globally, over 134 million have received a dose of the vaccine. Available, the Moderna and the Pfizer each requires 2 doses. The Pfizer, 21 days after the first dose approximately, and the Moderna, 28 days after the first dose. And I can attest to the Moderna. I just received my second dose 2 days ago, and there are a few side effects that one has to endure, but that's a lot better than getting COVID. The good news is that there is a third vaccine that should receive the EUA in approximately a month, and that's the Johnson & Johnson vaccine. That is a single dose vaccine, not quite as efficacious as the Moderna and Pfizer, but it has many attributes, including its 1 dose, and it's stable at room temperature or requires minimal refrigeration, which means it can be distributed to more remote places where the other vaccines require freezing or greater refrigeration. So the good news is that during the course of this year, we expect that there will be the administration of these 3 vaccines and possibly a 4th that will help inoculate the majority of at least the US population and hopefully the world population. However, as I stated earlier, we must continue to adhere to CDC guidelines, mask wearing, social distancing, and washing of hands. This is critically important. Even with the vaccines, those that are 95% efficacious, there still is the remote chance that one can contract COVID, although based on the data, those that would even get COVID who have been vaccinated, the cases are not severe at all. We also have a continued advancement and development of new and additional therapeutics for treatment of COVID-19. So if you haven't been vaccinated yet and you get COVID, there are monoclonal antibodies which have been perfected by both Regeneron and Eli Lilly. And this treatment, which is an infusion, if given to patients early on, once they've contracted COVID, prior to requiring hospitalization, it is proven to help lessen the severity of a case and mitigate the need for anyone to go to a hospital. You've also probably heard of remdesivir, which is an antiviral perfected by Gilead, and that is also used in the treatment. It's our expectation that there'll be other treatments for people with COVID, and as I said, there's a 4th vaccine after Johnson & Johnson that's on the way. So one can expect that by the summertime, hopefully, most of the population will be offered the vaccine. However, there are anti-vaxxers, people that are reluctant to take the vaccine, and the government has to convince the majority of people to take the vaccine. So we approach what they call herd immunity, which will be extremely helpful. From an investment perspective, we hope that by the summer, if the majority of the population has been vaccinated, as we get into the fall and the winter of this year, the economy will open up, less people will be sick. I guess one other statement I should make, if there is a silver lining to this horrible situation, the number of people contracting the regular seasonal flu is virtually none. So that will help save some lives as well. The next slide, please. From an investment standpoint, we've been on a roller coaster this past year. As you can see from the chart on the upper right corner, the NASDAQ on March 23rd of 2020 collapsed and went down to 68.61. But by the end of the year, looking over the valley of this economic lockdown that we were forced into, the NASDAQ closed at 12,888. Quite a jump. Same thing with the S&P. We had a 35% drop roughly to 2237, 323.20, and we closed the year at 37.56, and we're higher than that now. The Dow was as low as 18,000, and it closed the year at 30,309. So if you look at the graph with the red, the blue, and the green, you'll see that in March, April, we went way down. But those who stayed the course, those who invested for the long haul, those who had a prudent asset allocation and were able to emotionally withstand that sort of volatility or that roller coaster, went all the way down, but then came all the way back up, as you can see by the 12/31/20 closing prices. And by the way, each of the NASDAQ, S&P, and Dow Jones Industrial Average are slightly higher than the close at 12/31/20. So again, for investors, this has been a roller coaster, and one that happened very quickly, as opposed to the financial crisis of 2008 and 9, where it took until 2010 to get back up above a certain level. Here, this happened very quickly. I hate to use the term warp speed. It's very helpful in getting vaccines, but we had a warp speed decline in all three markets, and then we've had somewhat of a warp speed recovery. So again, we've been on a roller coaster, but there are reasons why we've recovered. Next slide, please. As you can see, we always talk about GDP growth and how important that is to investing and how important that is to a helpful economy or a healthy economy. As you can see in the quarter ending 6/20, the S&P GDP dropped by 31.4% after a smaller decline for the first quarter ending 3/20 of 5%. And then miraculously, for the quarter ending 9/20, the GDP growth was 33.4%. I believe that was the highest on record. And then since then, we've had a 4% increase in the last quarter of 2020. And as you can see, we're projecting 3%, 8%, 5%, 4% going into 2022, a continued growth in GDP as the economy normalizes. Now, we had some help in achieving this recovery. There was something called bipartisan relief of $3 trillion. I know in this day and age, it's hard to consider anything being bipartisan, but in the throes of this crisis back in 2020, both sides of the aisle came together to pass a CARES Act with $3 trillion in relief, which was incredibly helpful, which included relief to people that were out of work in terms of unemployment extension, relief to small businesses, relief to hospitals that were helping people with COVID, just relief in also incentivizing companies to come up with cures and therapeutics. So we had a bipartisan relief of $3 trillion back at that point. We also had a Fed with monetary policy, which we'll get into a bit later, expanding its balance sheet, dropping interest rates to zero so that we could have that kind of rebound in GDP growth. Then towards the end of the year in December, there was another $980 billion approved by both sides of the aisle and signed by President Trump, former President Trump. That $980 billion is still coming into the economy right now. And there's potentially another $1.8 trillion being considered by the new administration to address the relief that's still needed for those that are unemployed, for small businesses, for better testing, more vaccinations, et cetera. So there's a huge amount of money that has been pumped into the economy to give us confidence that we have bounced back, we're recovering, and as you can see, we're projecting GDP growth and no recession through the end of 2022. Next page, please. Another measure of our economic overview is that of unemployment. And as you can see, we show by quarter, starting in 2019, 3.9 in second quarter, 3.7, 3.6 in the third and fourth quarters, and then 3.8 in the first quarter of 2020. those percentages of unemployment were actually record lows, or lows that we haven't seen in 50 years. And then you can see, as the government forced an economic shutdown to stop the spread of COVID, our unemployment jumped to 13.1%. Then came all the relief I described a few moments ago, and the unemployment rate started to drop from 13.1 to 8.8, and at the end of the year, 6.8. And actually in January, it was 6.3%. However, it's a little misleading, the most recent quotation of 6.3 in January. That's not quite that good, as a number of workers dropped out of the workforce, which made the unemployment rate a little bit better than it is. But the trend is obviously in the right direction. Unemployment is getting lower and the economy is doing better. And we still have roughly 94% or 93% of people employed and helping the economy. Next slide, please. Another factor that we look at that contributes to a robust stock market and other asset classes that we invest in is the money supply. Again, at a time of stress, what has the Fed done? What has the government done? It's created money supply. And as you can see, here we have the M2, and Phil will go into another slide later on the M3, but we have an increase, a substantial increase, 33% in the money supply. And this pumps money into the economy. It helps create liquidity so that businesses can survive, consumers can spend or save, as the case may be. And it's certainly some of this liquidity ended up in the equity and bond markets, supporting both of those markets and taking our stock market to new highs, which again is a little bit surprising in the environment that we're in, but totally understandable when you see earnings growth and you see monetary growth and you see bipartisan support from a fiscal standpoint supporting our economy. Next slide, please. Something that we look at and speak to you about on a quarterly basis, if not sooner or more frequently, are S&P earnings, which is sort of a guide as to what creates reasonable valuations, what companies we want to invest in. Excuse me. As you can see, in 2019, the average or the earnings for the year were $160 for the S&P. Then came the pandemic in 2020, and we dropped to $138. But as you can see, we went from a high of $41 in Q4 to $33 to $28 in Q2, and then rebounding to $38 and $40 in Q4 of this past year, for a total of $138. And the reason why we're cautiously optimistic is that if you look at the next two charts or the next two graphs, we bounce up to $171 in projected S&P earnings for this year, substantially greater than last year at $138, and even exceeding the $160 achieved in 2019. And our estimates for 2022 are $198. Now that shows significant earnings growth for the average large company in the S&P 500. Some of those companies we invest in, and their earnings growth are even somewhat better, we believe, than what's being depicted here. But the key for us to recognize is that we've come out of the pandemic from the standpoint of an economic shutdown. We're continuing to reopen. That's reflected in the projection of $171 for the S&P. And also, as we look through the valley or over the valley of this despair from the pandemic and the reopening of the economy and the mass vaccination of the American public and the global world, we go up to $198 in 2022. So the trajectory of earnings, as we look at them, is much better going forward. Next slide, please. And of course, that makes valuations even more reasonable. Now, some additional economic indicators that we look at. Consumer confidence, as you see, was at a very high point prior to the pandemic. It dropped obviously with the pandemic and with the anxiety of knowing that people were dying around us and very sick, and that we were looking for a vaccine. And that consumer confidence has popped up a bit, excuse me, and stabilized. A very interesting chart to us is the personal savings rate. Now, in this country, having a savings rate of 3, 4, or 5% was typical. Here we bounced way up to over 35% at the height of the pandemic when people were frozen. Now, remember, many people were still working. They were accumulating their paychecks. They couldn't go on vacation. They couldn't go to a restaurant. They couldn't go to the movies. They went on Amazon. Unfortunately, we own a good amount of Amazon stock. But nevertheless, savings rate has dropped back down to about 13%, which is still significantly higher than in periods in past history. And that just means that there's a lot of pent-up demand out there, a lot of personal savings. We've also seen credit card debt go way down. So this is a very good indication of what will happen as the economy opens up and people have a desire to spend. We call that velocity, and that velocity drives GDP growth and will help the earnings of some of the companies that we invest in. If you look at the bottom two charts, single family home, new homes sold, you'll see that we dropped somewhat sharply with the pandemic, and now we've risen back up. And actually, there's a need to build new homes, and there's a demand for new homes. And if you look at lightweight vehicle sales, you'll see again a precipitous drop at the height of the pandemic, or the fear of the pandemic, and a significant rebound. All of this explains to us or contributes to our belief that the economy is rebounding and that earnings are going up as shown in the projections on the prior slides, and that we remain cautiously optimistic that the investments that we have will continue to prosper over time if you invest for the long haul while not being too greedy and not being scared away by corrections which are typical for any market environment. And with that, I'll turn it over to my partner, Phil Malakoff.
Thanks, Bob. So in summing up 2020, it was really the year of three Ps: the pandemic, policy, and politics. And Bob has already spoken about the pandemic, and I'm going to spend some time discussing the government's policy response to it. It'll be an understatement to say that the government reacted with some fiscal and monetary stimulus as a response to COVID. What they actually did was deliver a mega stimulus, a response that dwarfs anything we've experienced before. It was delivered quickly and aggressively, and it will influence our economy for years to come. The chart on this page shows that the growth in money supply, as defined by M3, expanded very quickly by 10% within 3 months of the start of the pandemic, and by 18% within 6 months, and has leveled off in the high teens. I just want to talk about M3 for a second. M3 differs from the previously mentioned M2 in that it includes large time deposits, institutional money market funds, and short-term repos, and as such is more closely associated with larger financial institutions than small businesses and individuals. M3 is known in Fed speak as broad money. So returning to the chart, during the global financial crisis of August 2008 to September 2010, M3 never expanded by more than 10% and spent most of those 2 years advancing in the mid-single digits. So we can see that the recent actions taken by the government in response to COVID were very strong and very aggressive. As Bob discussed earlier, the stimulus provided incredible power to the economy as it rebounded strongly in the second half of the year, and that is expected to continue into 2021. According to JP Morgan, the economy can expand by 10% on a nominal basis this year. They also believe that unemployment, which was over 13% in the middle of last year, can return to 5% by this year end. And as Bob just mentioned, recent data showed that the current employment rate is about 6.3%, although that may be a little bit understated. Let's go to the next page. So, starting in March of last year, the federal government took unprecedented and bold actions to bolster the financial system by passing the CARES Act. This act infused about $2.4 trillion to individuals, businesses, hospitals, and local governments. Funds were used for PPE and medical equipment, small business aid, and unemployment benefits. Some of these funds were also used to help develop a vaccine for COVID, and incredibly, multiple vaccines were developed, showed efficacy with an appropriate safety profile, and approved for human use in record time. Late last year, the government approved the COVID relief package, which provided $980 billion of funds in the form of checks to lower income earners, rent and food assistance, $68 billion to purchase and distribute vaccines, as well as broadband access, transportation aid, and education support, amongst other items. And early this year, both houses of Congress passed budget resolutions on a $1.9 trillion relief package. And while the House and Senate are ironing out the details on the two slightly different packages, a new bill is expected to be passed within a few weeks. All in all, that's over $5.25 trillion of government support in less than a year. Let's go to the next slide, please. So on this slide, you can see the Fed funds rate since 2005 with projections for the next few years as delineated by the red and green dots on the right. We can see that in the 2016 to 2019 timeframe, which is located just to the right of the middle of the chart, rates slowly moved higher in a stair-step fashion before starting to move a touch lower in late 2019. In February of 2020, the Fed funds rate stood at 1.5%, and the Fed began to state its concern about coronavirus on a global basis. Less than a month later, the Fed, in two unscheduled moves, slashed the Fed funds rate to zero, stating that the coronavirus outbreak had harmed communities and disrupted economic activity in the United States. In June, Fed Chairman Powell stated that the Fed is not even thinking about raising rates until 2022, and in September signaled that rates would remain at zero until 2023 to help the economy recover from the pandemic. This can be seen in the dot plot matrix on the lower right of the chart that says red, yellow, green dots. And we can see a bit of upward movement forecasted starting in 2024. Let's go to the next slide, please. Okay, so in addition to keeping rates low for an extended period, the Federal Reserve is committed to supporting the economy by making asset purchases, and they've significantly expanded their balance sheet, as you can see all the way on the right of the chart. At year-end 2019, the Fed's balance sheet was just over $4 trillion. Once the pandemic hit, they committed to a massive $700 billion quantitative easing program by purchasing at least $500 billion of U.S. Treasuries, which is the blue area on the chart, and $200 billion of mortgage-backed securities, which is the red area. In April, the Fed committed to make $2.3 trillion in loans as part of the stimulus package under the CARES Act, which I discussed earlier. And in June, they expanded the Main Street lending program to allow more small and medium-sized businesses to receive support. The Fed also raised its monthly quantitative easing commitments to $120 billion per month. And just last month, the Fed reiterated this commitment and said that it will remain at that level for the foreseeable future. By the end of January, the Fed's balance sheet had expanded to more than $7 trillion, up about 75% from where it was just a little over a year ago, and $3 trillion more than it was just over a year ago. Let's go to the next page, please. Okay, so this is a very interesting page. It has a lot of interesting data on it. So what it does is it tracks 7 consumer spending metrics from before the pandemic in January of last year through the height of the economic recession to where we are today. And what we can see is that at the height of the pandemic, 6 of the 7 metrics fell by at least a third, with 3 of them falling sharply. The one indicator which didn't experience a significant decline was retail sales, which is the purple line, and that was down only 10% at its worst point. This was due to consumers transitioning from going to stores to online shopping, as well as receiving funds from the stimulus of the CARES Act. Additionally, there was strength in the housing market. While purchase mortgage applications, which is the light blue line, did fall by 35% at its lowest point, it rebounded strongly from last summer through the end of the year. And you can see that for most of this time period, this category was at the top of the chart. Potential homeowners, who for the most part were working at home, sought out larger spaces and houses in the suburbs. Low mortgage rates also helped drive activity. Consumer debit and credit transactions, the orange line, and purchase mortgage apps bottomed out in early April, or the April-May timeframe, which was the low point of economic activity. However, these, as well as retail sales, have rebounded back and are now above pre-pandemic levels. Auto sales, which Bob referenced earlier and is shown here in pink, fell nearly 50% in the spring, have also rebounded sharply, but remain slightly below its pre-pandemic levels as of the most recent data. However, the other three indicators remain at depressed levels. Public transit demand, which is in green, seated dinners, as measured by the app OpenTable in dark blue, and TSA traveler traffic in red, are all metrics which involve interaction in public spaces. Whether you're taking a bus or a train, going to a restaurant, or flying on a plane, you will be in close proximity to and interact with numerous people. With so many people working from home, curtailing non-essential travel, and confining their social circles to small pods of people at their residences, those figures will probably stay low until people begin to feel safe venturing out into public spaces. We certainly hope that as more and more people get inoculated with vaccines, that many Americans will have confidence in returning to their pre-pandemic commuting, travel, and dining patterns, although we recognize that this could take a while. Let's go to the next slide, please. Areas to watch. So we're keeping an eye on a number of things. First, with a new administration in the White House and the Democrats effectively controlling both houses of Congress, we are watching to see what happens with taxes. We expect taxes on high-earning individuals and businesses to rise. We are also watching to see how taxes on capital gains in the states are impacted as well. We also expect a number of regulatory changes on businesses. The previous administration was business-friendly and loosened the regulatory environment. We anticipate that the new administration will enact rules and regulations that will make it more challenging for businesses to operate, ultimately affecting their profitability. I spent a bit of time earlier discussing all the fiscal and monetary stimulus measures that the federal government and Federal Reserve have implemented. Unfortunately, that more than $5 trillion in stimulus comes with a price, and in this instance, the price is an increasing amount of debt on the government's balance sheet. That amount is approaching $28 trillion, and it's grown from less than $20 trillion just 4 years ago. The stimulus will also increase the government's 2020 and 2021 annual deficits. 2020's deficit is estimated to come in at $3.1 trillion, most of which is due to the $2.4 trillion CARES Act. We continue to monitor inflation, which has remained low for many years. CPI is currently growing at about 1.4% year over year, well under the Fed's target levels. However, we're cognizant of the fact that at some point it will pick up, and it could do so in a very meaningful manner. One of our outside economic consultants believes that in the short term, there is enormous economic slack due to consumers and businesses retrenching during the pandemic, suggesting that inflationary pressures are likely to remain subdued in the near term. He goes on to forecast that within the next 2 years, there will be an inflection point, and a new inflation cycle could begin with consumer prices rising at the fastest pace in more than 2 decades. He believes that as our population becomes vaccinated, demand could come roaring back, overwhelming supply, and providing businesses with pricing power, and we could see 3 to 4% inflation as early as 2023. We will be keeping a close watch on this. Interest rates, those remain low, near but not at historic lows. Yields on long-term treasuries have been rising steadily since late August and more quickly since November 9th, when Pfizer announced an effective COVID-19 vaccine. The 30-year yield is now just under 2%, up from 1.6% before the vaccine announcement, and the benchmark 10-year yield has climbed as well, rising to about 1.15%, up from 0.8% before the vaccine news. We believe that rates could continue to move higher, but not significantly so. We feel, at the moment, there's a 1.5% cap on the 10-year Treasury for this year. Of course, there are geopolitical risks. How the new administration interacts with China, North Korea, Iran, and other untrustworthy countries will affect the balance of global power. Global climate control, high unemployment, discrimination, income inequality are also areas that are worth monitoring. And last but not least, our investment markets have recently been subject to excess speculation in certain areas. Surging cryptocurrency prices, the recent popularity of early-stage companies going public through SPACs, increasing levels of IPOs at lofty valuations, as well as short squeezes driven by young retail investors, and I use the term investors very loosely, have led to signs of froth in some investment pockets. At FLI, we don't travel in those speculative areas. As we've mentioned to our clients many times, we seek out high-quality, financially strong companies which are leaders in their industries, trading at what we believe to be attractive valuations. My colleague Brian Gamble will go into more detail about our investment approach.
Thanks, Phil. Okay, so for those of you who have joined us before, you've seen this slide many times. This is our roadmap for how we view the investing universe. So we have our lower risk, lower return investments on the left-hand side, higher risk, higher return on the right-hand side, and kind of graduated scale as you move from left to right. So security investments are designed to kind of be an anchor and hold the portfolio steady in good times and in bad, just to be a rock in the portfolio, basically. Our defensive strategies are designed to have good downside protection along with meaningful upside participation. So combination of kind of that, and then you have traditional equities, which are more designed to appreciate on the upside and kind of follow the equity markets. And then additionally, we have private investments, which tend to be more illiquid in nature and more idiosyncratic, more unique one-offs than anything else. Our high-level approach has been pretty steady recently with some minor tweaks that I'll get into shortly. We continue to remain underweight fixed income with a focus on quality and shorter duration. We continue to overweight our defensive strategies, even more so given the current environment. And we continue to recommend a modest underweight to traditional equities, but within this basket is where we are slightly shifting our allocation as we have been increasing our value and international exposure a little bit. And we continue to utilize private investments as opportunities arise and where appropriate. And obviously, this is an overall framework that is customized and adjusted over time for each client as his or her individual needs and situation changes. Next slide, please. As part of an overall asset allocation, most clients should have a fixed income allocation, but this slide is the main reason why we remain underweight this basket. It shows the yield on fixed income instruments are paltry, especially when you consider inflation. Inflation is currently running at about 1.4%. Pre-tax, all the fixed income instruments shown here are yielding less than inflation, which leads to a loss of purchasing power over time. Essentially, the cost of goods and services are growing faster than the return on fixed income assets. This puts investors in a difficult position. In comparison, if you look at the two rightmost bars, you can see that the S&P 500 yields a little less than the rate of inflation, net of federal tax. However, our dividend growth strategy, which is part of the defensive basket from the earlier slide, yields well in excess of the rate of inflation, even net of federal tax. In addition, while the yields on fixed income instruments are generally fixed, we target 7 to 10% annual dividend growth from our dividend growth strategy. Thus, in order to keep pace with inflation and not lose purchasing power, one must not own too much fixed income while utilizing a prudent, customized asset allocation. Next slide, please. An important component of our defensive basket is our dividend growth strategy. Our strategy is predicated on the Gordon growth model, derived by Professor Myron Gordon, which, when distilled down, states that the future expected return of a stock is approximately equal to its current dividend yield plus the sustainable growth of its dividend over time. The chart on the right depicts how our dividend growth strategy has fared versus the expectations based on the Gordon growth model. Our dividend growth strategy has returned 13.2% net annualized over the last 5 years as of December 31, while the Gordon growth model would have predicted a 12.2% return based on a roughly 3% dividend yield and 9% dividend growth. High dividend-paying stocks that consistently raise their dividends can provide stability and appreciation in an environment of economic uncertainty. During 2020, dividends received by our strategy grew by 5.2% versus the S&P 500, where dividends grew just 0.1%, and versus the Russell 1000 Value Index, which is our primary benchmark, where dividends declined by 10%. So far this year, our dividend growth strategy is averaging a 10% dividend increase. Additionally, dividends currently enjoy a favorable federal tax rate, but as Phil mentioned, we'll wait and see what the new administration brings from a tax standpoint. Next slide, please. So let's switch gears for a moment and talk about valuation. Over the next 2 slides, we'll delve into valuations and how we're seeing things. On this slide, you can see the cumulative flows into fixed income and equity ETFs and mutual funds since March 2009, the bottom of the financial crisis. Since then, you have seen flows into fixed income assets amount to almost $3 trillion. This vastly outpaces equity flows despite the last decade plus having been a very profitable time to be invested in the equity market. Investors have now fully embraced the equity market since the financial crisis and have instead chosen to chase even lower yields on fixed income instruments, to the point made earlier where most shorter duration instruments do not keep pace with inflation. For longer duration instruments, there is significant interest rate risk if and when rates begin to rise again. The weakness in equity flows is a positive contrarian indicator to us. Next slide, please. Moving to the next slide, some of you may be familiar with this chart. It compares the earnings yields of the S&P 500, which is the inverse of the price-earnings ratio, to the 10-year U.S. Treasury yield. This shows that currently stocks, the blue line, are more attractive than bonds, the red line. Stocks are generally considered more attractive so long as the earnings yield is greater than 80% of the bond yield, due to the fact that earnings grow over time while the interest payments on a bond are fixed. So while many point to concerns over valuations in the equity markets, we believe that given the current interest rate environment, equities are not cheap, but they are not in nosebleed territory either. Coupled with the recent strong performance, we have been recommending clients maintain a modest underweight to traditional equities. Next slide, please. Within traditional equities, we've started to shift a little more towards value and international, as mentioned earlier. As you can see on the chart, growth has significantly outpaced value since December 31, 2007, comparing the darkest blue line to the lightest. Through both the Great Recession of 2008 and 2009, as Bob coined it, and the most recent downturn early last year due to the pandemic, with a slow-growing economy, growth companies typically perform better than value companies, but given the projections for stronger GDP growth discussed earlier as the economy recovers from the effects of the pandemic, we've been shifting a little more towards value, as value stocks typically perform better during periods of robust GDP growth. Additionally, on the chart, you can see that domestic, the 3 blue lines, has dramatically outpaced international, the 2 green lines, over the same time frame. We continue to believe that a domestic bias is warranted, but have started to shift a little more towards international, slightly increasing its allocation. Next slide, please. Okay. Last but not least, on this slide, we can see the money mountain, or the amount of cash on the sidelines. You can see on the chart that the amount of cash on the sidelines has spiked to record levels recently and has only started to come back in, but is still above the level reached during the financial crisis of 2008 and 2009. This large money mountain on the sidelines continues to earn next to nothing in cash, and Treasury bond yields are at or near historic lows, as we discussed earlier. This suggests to us that some of these funds will seek asset classes with better returns in the near future, including equities. Again, we take this as a positive contrarian indicator. And with that, I'll hand it back over to Bob for our summary.
Thank you, Brian. Thank you, Phil. In summary, COVID-19 is a devastating illness that has had a health and financial impact on the entire world. There is light at the end of the tunnel from both the medical and economic standpoint, but we have to be patient. relating to both. The U.S. equity markets are strong despite the pandemic and are expected to continue to see growth in 2021, albeit possibly muted from 2020 and perhaps with some greater volatility. Again, I go back to don't be too greedy and don't get too fearful. Unemployment has been on a steady decline, but still has a long way to go in order to reach pre-crisis levels, and certain industries are still struggling, and that will be addressed in the next relief package that's being negotiated in Washington. Swift and bold federal action was taken throughout 2020, and an additional round is expected in the not too distant future, as I just mentioned. The debt, deficit, and inflationary impacts of these actions will need to be addressed in the future, and we'll watch that carefully, and we'll address it through asset allocation when necessary. We believe being patient with a prudent asset allocation that is overweighted to defensive strategies, while underweighted to fixed income and slightly underweighted to traditional equities, is the best course for most investors in these uncertain times. Maintaining enough cash and high quality short-term fixed income to sleep at night is important, but being primarily invested is the key to long-term asset growth. In order for our net worths to grow above the rate of inflation, we need to be able to compound at a reasonable level. That requires an adherence to long-term investing. Concentrated portfolios of companies with strong fundamentals and managed with a focus on quality and secular growth trends and/or growing dividends should prove successful over the long term. And as Phil pointed out, we don't play in the sandbox with the very speculative investments. We've got to own companies that have strong fundamentals, that have earnings, dividend growth, and have good managements and are not over levered. That's the key, we think, to success over the long term. Reviewing your overall wealth management plan with an eye towards understanding the tax, charitable, estate planning, and insurance options is a critical step, one we can help with in conjunction with your accounting and legal professionals. That's the wealth management aspect of our business. Again, we thank you for participating, and now I think we'll go to Q&A. Karen.
Yes, thank you. Thank you, Bob, Brian, and Phil, for all of that insight. We do have time for some questions, so please use the questions dialog box to send them over, and we'll start with them. So the first question we may have touched on a bit, but was that given that valuations are priced for perfection, are we taking some money off the table and allocating slightly higher than usual to cash?
I'll take that, Karen. Price to perfection is an interesting way to phrase what some investors expect from certain companies. Let me just give you a historical perspective. And we touched on this during the presentation. Right now, the projected PE for the S&P, probably on next year's earnings, is about 19, say 19 to 20. On this year's earnings, 21 to 22. The alternative is the bond, 10-year bond as a proxy at 1.15. Let's go back to the year 2000 when we had an equity bubble and people were very concerned about valuation. But at that time, the S&P was trading closer to 30 times earnings, not the 19 to 21 or 22 we have now. And your alternative at that time, on average, was you could buy a 10-year US Treasury yielding slightly over 6% versus the 1.15% today. So when you look at it from a historical perspective, yes, things are not cheap, as Brian pointed out, but we don't think that they're nosebleed when you look back over history. We leave it to each of our subcommittees to determine how much cash should be maintained in a portfolio. We've readily said in our written pieces to you that we should maintain, or you should maintain, as investors, a cash buffer in either cash earning nothing, which we understand, or short-term bonds. such that if there is some unexpected volatility, some exogenous event that we can't predict, and there is volatility in the market, you have enough of a buffer that you will not make an emotional decision to sell out in your equity positions, let's say, at the wrong time, and then try and jump back in when you think it's right, because none of us ever get that right. So we aren't actually increasing our cash in each strategy. We typically run with about 3 to 5%, depending on the strategy. But we do encourage our clients, and we work with our clients to maintain some cash on the sidelines or short-term bonds. We'd rather handle it through asset allocation than raise a significant amount of cash in any given strategy, since we have good long-term belief in our holdings in each strategy.
Bob, can I expand on that a little bit, please?
Sure.
Yeah. So I disagree with the question, or whoever asked the question, that the markets are priced for perfection. Are they a little bit more expensive than historical, norms? Yes, they are slightly more expensive. But I think, there's a couple of responses to that. One, I talked about in my section how rates are near historic lows, and that really plays into the discounting mechanism of how stocks are valued, how companies are valued. So when interest rates are low, you discount back cash flows, you get more bang for your buck. So theoretically, PEs should be higher when interest rates are low than when they're at more normal rates or at high rates. So I don't think that equities as a whole are priced for perfection. Could certain individual securities be priced for perfection? Yes. But what we're seeing is that earnings are coming in and they're beating expectations. I think 80%, I saw a statistic earlier in the week, 80% of S&P 500 companies have reported, and something like 40% of them have beaten expectations, and talking about guidance going higher. So we're not really seeing that price for perfection. And just to take that just a step further, in our DNA and in DNA of FLI, in talking to other really outstanding managers, they will say that you make more money when equities go from fairly valued to overvalued than when they do just getting to fairly valued. So even if we're saying they're fairly valued now, this is really an opportunity to expand that.
Let me just summarize what Phil and I are trying to say. Holding cash or short-term bonds as a buffer makes sense for you to sleep at night and to have just that buffer, that insulation against volatility, recognizing that you'll be earning well below the rate of inflation. And all investors, not just those of us on this webinar, but major institutions that I work with, and I participate in discussions with major banks across the country who advise major pension funds, major charitable endowments. As you all know, I sit on a few boards with major endowments, and they're confronted with the same issue. If you need to earn about 5%, how can you do that when your cash and fixed income is between 0 and 1%? So what we're seeing is that many large institutions are actually shifting a little bit more towards equities, whether they be defensive or they be more traditional. There is a move because they don't want to earn less than the rate of inflation, and they believe in long-term investing. So again, we go back to this should be handled individually for each client with their own prudent asset allocation. Some will be much less risk-oriented, some will be a bit more risk-oriented. And that's where the consideration of cash and short-term bonds should be handled. But, we remain cautiously optimistic over the long term.
Great. Thank you both for that. Our next question is, you mentioned obviously that we're watching for potential tax increases. If a tax increase were to be passed this year, do we have any perspective on if we think that will be retroactive to January 1st? And if so, what will be the impact on investors?
I'll take a shot at that again. we've had some discussions with people on both sides of the aisle, and one in particular who's on the Ways and Means Committee and is a Democrat, and he helps write tax legislation. And there's a discussion ongoing now between the desire of the extreme left to raise taxes on well-to-do people with the practical aspect of, do you want to raise taxes on businesses and high net worth individuals coming out of a major recession based on the pandemic? So there's a split in terms of whether that the tax increases that are necessary because of these major relief programs that are being considered, as well as possible infrastructure programs. There's discussion as to whether or not it should be as of January 1st of 2022 or retroactive to January 1st of 2021. We don't know. You see what's going on in Washington right now. So we can't tell you when it's going to happen, but we're following it very closely with discussions with Congresspeople on both sides of the aisle. I will say this, for those of you who live in New York, and that's your domicile, there's been a bill introduced by both Democrats and Republicans from New York to reinstate a full deduction for the state and local taxes that we pay. I won't handicap what I think the prospects are, but that's something that Democrats were most unhappy about in the Tax Relief Act that Donald Trump did. So there's a good shot, or a shot, that those deductions will be reinstated for those who live in New York. As to the effect on the stock market or on companies that we invest in, we're looking at their tax rates to see exactly what impact would be should the corporate tax rate go up to either 25 or 28%, which is what's being contemplated by the more moderate Democrats want 25%, the more extreme Democrats want 28%. And we're looking at what the impact would be on the average company that we own. Now, some companies that derive a lot of their earnings from overseas will be less impacted. Some companies that derive all of their earnings from domestic operations will be somewhat more impacted. But our research in the past has not shown that these tax increases or decreases really impact a lot on the stock prices of the companies that we invest in.
Thank you, Bob. All right, it's just about the top of the next hour, so that is all we have time for today. On behalf of the entire team at FLI, I want to thank everyone for joining us. We hope you found the session interesting and insightful. If you have friends or colleagues who you think would benefit from joining future events, please let us know. We can happily include them on the invitation list. For our clients on the line, I know it was mentioned a few times, but I do want to remind you that the investment committee is always available to discuss your individual asset allocation. Just give us a call. A new year is always a good time to do a holistic review, and we're here to help you discuss your individual situation, needs, and goals. We hope to see you all in person again very soon, but in the meantime, know that we're completely available. We wish you continued good health and ask that you please do your part and continue to wear your mask and practice social distancing. We hope everybody has a fantastic day. Thanks for joining us.
Thank you. Stay safe.